Before we jump into Bitcoin and blockchain and all that great technology, we really need to step back and ask a really important, simple question. What is money? And I don't mean simply money as a means of exchange, or money as a store of past effort, or future returns, or whatnot. So to answer that question, you got to think about the fact that money is a hierarchy. That, in fact, there are a lot of different things inside the word money that are not the same thing, but on a daily basis, we just consider them all money. So here in front of you is the hierarchy, or just the top of the hierarchy. And so the very, very top, it used to be that gold was real money. It used to be 200 years ago that when countries needed to settle up, or international companies, right? The Dutch East Indies Company needed to settle up with China, they would use gold. Gold was accepted around the world and has been for thousands of years. But here we are in the 21st century, and that's no longer true. So while you can buy and sell gold, it's no different than buying and selling silver, or buying and selling oil, or buying and selling real estate for that matter. Gold is just one more thing that stores value. It's no longer money. The top of the hierarchy today is paper currency. The pieces of paper that the governments print, that you can hand around in stores and buy things with. That is real, absolute money. When paper currency first became popular, which is hundreds of years ago, it wasn't money. It was just a promise to trade those pieces of paper for gold, which was real money. But now it's not a promise anymore. It is just what money is right now. Usually, we don't actually do the transactions with these paper bills, right? More and more, we're making transactions with credit cards and other electronic means. But even before that, even for the last 100 years, most of the time we do transactions with checks, or we do transactions with wires. Most of our money, most of our liquid money is actually sitting in a bank. And what's really interesting is that those bank deposits are treated like money. And when everything is going well, when the economy is doing well, when everything's going fine, they are exactly the same as money. They trade at par, we say, with money. $1 in a bank account is worth $1 in your pocket. $100 in the bank's worth $100 in your pocket. When you have $100 million, then things get a little tricky. But in the everyday life, bank deposit is as good as money until it's not. And so when there's a panic, and we saw a panic in 2008, 2009, there's been lots and lots of panics in the last few hundred years. Well, when there's a panic, the banks just say, no, we're just not going to give you your money. They just close. And sometimes they go out of business. We have insurance by the government to protect that. But when all's going well, your bank deposit is just a promise to give you back the currency that you gave them. And then the hierarchy continues down. So a loan, or a money market fund, which is a basket of loans, is a promise to pay you not money. It's a promise to pay you bank deposits. You bought the money market fund with a bank deposit. You wrote them a check or wired it over, and they're going to pay you back bank deposits. They're not actually going to pay you back currency. You're trusting the bank to give you the currency when you want it, but the money market fund's just trusting that the banks actually have the deposits that they're talking about. And then the hierarchy goes down further, because you can have forwards and futures and other derivatives that are, in fact, promising something about the loan. They're promising a sliver of a loan, which is then promising bank deposits and promising currency and so forth. So in everyday use of this hierarchy, when you're writing a check is a promise to pay a bank deposit. It's a little bit like a loan. It's like a zero interest, really short-term loan, but you're going to write on a piece of paper, please pay this company or this person some money out of my bank deposits. And your bank is going to send some of those deposits to their bank, and their deposits will go up, right? No actual money changes hands, just bank deposits. Now, when you take out that piece of plastic in your wallet that's called a credit card, and you make a transaction using that, that's actually a loan, right? So the credit card company is lending you the money for 45 days, and they're paying off the merchant probably tomorrow, and it's actually a loan. The credit card company is floating you this loan, which, crazy enough, again, they're going to get paid back not with money, they're going to get paid back with bank deposits, because when all goes well, bank deposits are as good as money. And then lastly on this hierarchy, just to make it messier, you think about those direct deposits, or when you use bill pay now. And so an ACH is really just a check. So a check, if you think about it, is a piece of paper with the number for the bank, the routing number, and your account number on it, and a signature saying that you actually did the transaction. And an ACH transaction is exactly the same thing without the signature and without the paper. It's just the routing number, the bank number, and your account number. Now, this whole system works. It has worked for hundreds of years, and the reason it works is because it's all built around trust. And so it's not terribly important that you understand all these different levels and how they all interact and what goes wrong when things go wrong. What you need to understand is that the hierarchy of money is really a hierarchy of trust. You trust the paper currency because you trust the government that printed it. You trust your bank deposits because you trust the banks and the insurance that the government has put on those banks. But you trust that the banks will give you your money. Loans require trust, derivatives require trust, and so on and so on and so on. The whole system is just trust all the way down.